Within accounting changes and error analysis, everything must be material to matter. Consequently, remember that for this whole class, we assume that items we discuss are usually material in nature, no matter what type of company we're discussing. There's several classifications that we have, classifications in changing in the accounting principle from GAAP to a different GAAP change. New literature with the FASB statement number 154. The change in accounting estimate. An example of this is changing the useful life of the assets. And a report of the changing the entity, which an example of this is changing specific subsidiaries in consolidated financial statements. A change from one GAAP to another GAAP. A change is not considered to result a new principle is adopt in recognitions of events that occurred for the first time or that were previously immaterial. Change from non-GAAP to GAAP is not an accounting change, but rather considered a correction of error. What other notes should we take? A change in principle. Enterprise must demonstrate that the new GAAP is preferable to the existing one in order to obviously change it. Three possible approaches for reporting changes are retroactive, currently, and prospective. Prospective, of course, is going to be the adjustment to the current and future years, and retroactive is what occurred in prior years. So how do we know which one to obviously use? For years and years, we often use a cumulative effect method. But that recently changed due to convergence. GAAP requires a prospective approach, which is what we learned in section 136A. You'll have to report each year presented if there's a new principle that is currently in place. For the first year presented, make sure to adjust the balance sheet accounts, including retained earnings, for the cumulative effect up to that point. So as you can see here, just the accounting change and an analysis of it is a lot more difficult than what people can imagine.